Michael Burry just shorted the entire market. I want to talk about this, talk about whether this is a time to be worried, talk about what just came out on national TV. Head anchor for a financial show just talked about how young people should not have bonds. They should be buying Bitcoin instead. I want to talk about that and some other pieces of news. If you don't mind, hit subscribe, turn on the bell notification. This is going to be a banger of a video. And if you want to trade crypto, there's a link down there to BITGET. If you want to know what I'm buying and selling, there is a link down there to the Patreon. As you can see, Bitcoin moved up a little bit earlier today, now moving down a bit. But everyone is talking about this. Everyone's watching this. Michael Burry just shorted the market with $1.6 billion. This is 93% of his portfolio. A huge amount. Imagine going short the market with your entire portfolio. You have to have pretty strong conviction. So he bought 890 million of SPY puts and 740 million of QQQ puts. So QQQ, obviously more tech-based. SPY is everything, S&P 500. But he is buying essentially the entire market on the short side. Now, this can be kind of scary. For a lot of people, this is worrisome because, well, first of all, he's built up a huge fortune. Now, if you don't know who Michael Burry is, maybe you just haven't been paying attention the last few years, that's fine. He made a ton of money betting against the 2008 real estate market. He also bet against the 2001 tech market as well. So he's been able to amass a large amount of wealth back during the 2007 through 2009 housing crash. He made around 100 million for himself and 700 million for investors estimated. And there are a lot of different numbers out there for how much he's worth, but I think everyone pretty much says at least 300 million. Some say up to 1.4, 1.5, 1.6 billion, which makes sense with this portfolio size. But, this may be a time where he's right. That's what a lot of people are thinking, right? When the S&P 500 moving up pretty drastically this year. But it's really just due to 7 companies. A lot of people are worried maybe the market's not as strong as people think. The S&P 500 minus those 7 companies, NVIDIA, Alphabet, Amazon, Apple, Meta, Microsoft, Tesla. Without those 7 companies, this is from a couple months ago, but without those 7 companies, we're at like negative 1% versus a positive 7%. Again, this is from a few months ago, May 16. But really, those companies have been propping up the market. A lot of people are worried, hey, what if the Fed can't engineer this soft landing? What if inflation is stickier? We've had the CPI and PPI both tick up last month after going pretty much straight down. Now they're ticking up. Maybe it's stickier than we think. Maybe this is going to cause a recession. And that's why Michael Burry's betting on this. Right? He's obviously knowing something that we don't. He's betted like this in the past, made hundreds of millions of dollars, and he's going heavy into these different put contracts. Now, that's the bear side. But I think it's better to be long this market. I'll be honest. There are a couple different reasons for this. One, the report was dated June 30. Michael Burry is someone that gets in and out of positions quickly. This was from a month and a half ago. He just had to report on it today. So he could already be out of these positions. He's already said before that he was wrong on the market. This was months and months ago, but he has been wrong in the past. And here's actually 10 different times that he was wrong. A lot of them recently. Back in 2019, he said that he was predicting a market crash. He said that index fund inflows were distorting prices for stocks and bonds in much the same way that the CDO purchases did for subprime mortgages more than a decade ago. Indices are up since 2019. He said that Tesla was trading at a ridiculous price. He actually went short Tesla at one point as well. He said that several times. Michael Burry also said that he saw terrific stresses in the economy. This is back in 2015. Imagine you hear that, and then you do not buy the S&P 500. Since then, just since that time in 2015, the market's up over 100%. Michael Burry predicts an imminent stock market crash back in 2017. You hear it a second time. You think, okay, now the market's continuously gone up hundreds of percent. Maybe I shouldn't buy. Well, you would miss out on another 70, 75, 80% run. So the thing is, when you see Michael Burry go short, that doesn't mean too much, right? It means, yeah, he's betting against the market, but that's what he tends to do. He is someone that's usually bearish on the market. You don't see him go long on a bunch of tech companies. I mean, there are times that he'll buy into companies. He's not going short all the time, but he is often pretty bearish on the market. And this is from a month and a half ago. So just because he's right one time or two times in 25 years does not mean that he's always going to be right. Now, that doesn't mean you should never pay attention. When a large investor goes short or goes long on something, maybe it's worth paying attention to. I'd say it is. That's why we're covering it here. But that doesn't mean go and sell all your stocks, right? He might be playing a very short game. He can get as much information as he wants. He's well connected. He has lots of money. He can play these short games, and we can play the long game. Over the following years, the economies, even if it goes into recession, will probably bounce right back out. So far, the Fed's actually done a pretty good job of engineering a soft landing. And so far, it looks like we might actually be able to pull this off and go straight back into a boom. And I definitely don't want to do what he did, which was called 2010, 2011, 2012, 2014, 2015, say that the market was going to continue to crash or that it was overvalued and then miss out on a couple 100% gain in something like an index. You can't do that because then the high flying names, the good companies are going to go up more than that, 5x, 10x, 15, 20, 50x. So I'm not going to miss out just because Michael Burry says that now is the time to sell. Now moving on, there's an article today from Financial Times saying that the bond market is no longer safe. They say the charge against these government IOUs is pretty damning. Take the U.S. Treasury market, regarded as the safest bolt hole on the planet. But the return on U.S. Treasuries in 2022 was minus 17.8% compared with minus 18% on stocks in the S&P 500, fractionally safer than to the point of meaninglessness. Clearly, bonds offer no diversification relative to equities. In 2023 so far, U.S. equities have wiped the floor relative to bonds. This is partly illusionary because of the bounce in both the S&P 500 and NASDAQ indices have been driven almost exclusively by 7 of the biggest companies. Quite a turnaround. So they point out the fact that really treasuries can be very volatile and they're not necessarily the best option for every portfolio, especially when you could just go long and get much more upside and about the same downside. Now, recently we covered BlackRock actually talking about how if you have a 60-40 equity bond portfolio and you have a certain risk aversion of 1.5, the optimal BTC allocation is actually 85%. So depending on your risk tolerance, you should probably go heavy in Bitcoin just based on numbers. They even go as far as to say if you have an 80-20 stock bond portfolio and you have a certain risk tolerance, maybe it's best to do a levered long position of 106.6%. Here we have Financial Times saying it doesn't really make sense to invest in bonds. BlackRock saying, hey, you should really go long on Bitcoin instead of having bonds. It doesn't make sense for most people. And today we just got someone from Squawk Box that is on CNBC talking about how the younger generation should buy Bitcoin instead of bonds. Let me play this for you.
You know, from such a different generation. Should she be? She's got plenty of time. She's young. Should she be thinking about buying 4% bonds, or would you recommend she buy some Bitcoin, Jay? I mean, what would you tell Kelly Evans to do at this point?
What would I tell Kelly Evans? Diversify. That's what I would say. Diversify.
I'm kidding when I say don't buy a 2-year note, buy Bitcoin. Sort of kidding. I'm sort of kidding, but as you know.
Let's be clear. Bitcoin should not be a dominant portion of any investor's portfolio, okay?
Dead silence.
I guess can I just rewind for a second? So
she came and talk after that. Maybe she's a big Bitcoin bull. Maybe she doesn't want to ruffle any feathers. But that's really interesting. We have Joe saying this person's young, whoever they're talking about. They're young. They probably shouldn't have bonds. They should be buying Bitcoin. He's pretty bullish on Bitcoin. This other guy saying, diversify. He doesn't want to give personalized financial advice, but he says Bitcoin should not be the main part of any person's portfolio. Now, personally, I think it depends on the individual, and it depends on what you want to invest in, right? What your risk tolerance is. I think Bitcoin should be a part of a lot of people's portfolios, especially if they're chasing some kind of alpha, essentially. If they want larger returns, invest in Bitcoin. But yeah, investing the majority of your money in Bitcoin probably isn't smart for most people because they can't handle the mental taxation of seeing your portfolio go up and down 70, 80% over a few months. But that is really interesting to me, right? This article comes out to tens of thousands, hundreds of thousands of people saying don't invest in bonds. BlackRock says invest in Bitcoin instead of bonds. On national TV, this host says invest in Bitcoin over bonds for longer individuals if you have enough time, long enough time horizon. So things are changing out there. Pay attention. And with the spot ETF potentially getting approved in a few months, that can make it a lot easier to invest in Bitcoin. And then when ETFs start allocating towards Bitcoin, spot ETFs, in their, let's say, their retirement planners or their retirement date portfolios, if they start doing that, that's when people start buying without even paying attention to it. They just buy for 20, 30, 40 years, buying Bitcoin off the market, making it harder and harder to get your hands on it. So that is when we go parabolic. Now, some other news, just a couple things real quick. CoinDesk lays off 45% of editorial staff. Honestly, there isn't much happening in the price of crypto right now. There's stuff happening behind the scenes, but there isn't much happening with the price, which means not too many people are watching, which means that there's not that much ad revenue. That's just how it is right now in the crypto space. So makes sense that CoinDesk has to lay off some workers. Also, UBS is going to pay $1.4 billion over fraud in mortgage-backed securities. They say this is over legacy misconduct, talking about back in 2006, 2007, with the offer and sale of mortgage-backed securities. So this is obviously looking way back in the past, but it is nice to see that some banks are having to pay up, even if it's 15 years later. Nuts that it takes that long. But let me know your thoughts on all this underneath the video. If you've made it this far, let me know in the comment section by giving me a little cash emoji. Thank you so much for watching. I appreciate it, and I will see you in the next video. Again, if you want to check out some links to trade on BITGET, they have up to $8,000 worth of bonuses right now, and it's a great platform. If you want to know why I'm buying and selling, check out the Patreon. See you in the next one. Bye.